All right, hello, and thank you for joining the Fort County Parent Education and Support Group meeting today on Zoom. I'm Carrie Axtell, the Advocacy and Youth Programs Director. A little bit about us. The ARC of Fort Bend County is a nonprofit organization established in 1968 for people with intellectual and developmental disabilities, IDD, such as autism, Down syndrome, cerebral palsy, and more. We ensure opportunities for people with IDD and their families to maximize their quality of life within our community. We do that through disability rights advocacy for and with people with IDD. We provide information about community services and resources, organize resource fairs, support groups for parents and adult siblings. We hold several high-quality social and recreational programs for people in their teens, 20s, and into mature adulthood. We're also home to the largest Special Olympics delegation for adults in the region, offering 10 different sports and over 100 athletes. So the ARC of Fort Bend County is your go-to source for people with IDD in Fort Bend County. To learn more about us, visit our website at arcoffortbend.org and like our Facebook page, which we are very active on, and it's up to date. You can also reach out to me. I put our contact information and my email address there in the chat box. So let's go over what to expect today. When you logged on, your microphone was on mute just to help cut down on background noise and help us hear our speakers better. If you would like to ask a question during the presentation, please do. Feel free to unmute yourself. Brian and Tinja are very welcoming of your questions. If you're a little more comfortable with typing your questions, you can use the chat box, and I can read all questions at the end for our presenters to answer. We do learn a lot through your questions, so thanks for asking them. This parent education and support group meets on one Thursday each month throughout the school year, and the presentation is at 11 a.m. Then at noon, I stop the recording and the parent support group meeting begins. So if you want to stick around after the presentation, we bounce questions and ideas off of one another, and as fellow parents, we do have a lot of knowledge and experience to share with each other. If this is your first time joining us, welcome. You're in for a treat. There are some exceptional professionals here in the community who share their knowledge and expertise with us. This month, we're glad to welcome Brian Smith and Tinja Anderson with Mass Mutual Greater Houston, and they're going to present on income tax planning for families caring for children with special needs. Brian Smith is a financial advisor for Mass Mutual Greater Houston and co-founder of the Special Care Planning Team. He works with families to develop customized life care plans using unique and personalized strategies that maximize financial efficiency. He strives to build lifelong relationships with all of his families based on trust, respect, and ongoing advice on holistic life care and financial planning. Brian says, my passion is to serve, and it's born out of my personal journey and growth as the oldest brother of a child with special needs. I can relate to siblings and parents about the highs and lows of caring for a person with disabilities. I decided to become a special needs financial planner to help families like mine address the serious questions concerning their future well-being. I work together with parents and caregivers and siblings to help ensure lifetime care and quality of life. And Brian assists families with many issues, including understanding and assessing public benefits, preserving benefit eligibility through special needs trusts, and guardianship concerns. Brian's colleague, Tinja Anderson, is a financial services professional and co-founder of the Special Care Planning Team at Mass Mutual Greater Houston. Tinja was raised in a family of entrepreneurs whose entire mission is to create a legacy of excellence, meaning they leave anything they touch better than how they found it. And Tinja continues to apply that mindset to all aspects of her life today. Tinja says that there's nothing more fulfilling than knowing I can impact the lives of my clients, reduce the fear of not having enough, and by working as a team of special care planners to assist our clients in navigating the complex world of special needs. Tinja is also a sibling of a person who grew up with severe speech impediment and knows how important it is to find the community and supports that people need. So it is my pleasure to introduce Brian Smith and Tinja Anderson.
I love it. It's so, hi everybody, welcome. Thank you, Carrie, for that wonderful introduction. It's so funny when you write out your bio. It's we cover so many different topics, and it's hard to boil everything down into some minute bullet points around why we do what we do. But really, the reality is that Brian and I come at this from a sibling's perspective. We fully appreciate and respect how dynamic and complex navigating this planning environment is. And so doing the tax planning side of things, I know this is going to be a very in-depth presentation. And so Brian's going to give me where are you supposed to get off the stage? So we're very excited to present here today. If you have questions, please let me know, or just unmute yourself or chat box. So yeah, I'm going to pass the baton just because we got a lot to cover.
Awesome. Thank you, Tindra. See if hopefully you guys can have my screen up. And so today's going to be this is one of the more granular workshops we do. So please, if there's questions, type them in the chat. I'll go over them. Like I was explaining before, a few of you guys got in here. The numbers have switched literally every single year for the past 4 years. Last year, they reverted back to previous numbers because of COVID. 2021 is a whole different animal. So you're going to see a lot of numbers referring to 2018 and 2019. Those are still the same numbers for 2020, but moving forward, they have changed. And so I'll do my best to point those out, just so it's not as confusing. But if you do get confused, don't worry. Email us, call us, ask questions. We'll do what we need to do. And so jumping into the workshop. So just always got to give credit where credit's due. So this workshop, Mass Mutual Special Care, is a national program. And Thomas Brinker is the CPA that consults with most special care planners across the nation. And that he also helps us give tax planning advice and forward thinking. And he also makes a lot of our tax workshops. We are not CPAs. We're financial professionals, chartered special needs consultants. CPAs will file your taxes. We just educate moving forward. Hey, don't forget, if you do this expense, bring this up to your CPA, or take notes, or start calculating all the miles and the expenses you're paying for. That's our job, is to forecast and to think about the future, and to maybe look back a year or two and say, hey, maybe amend your tax return because there's a big itemized deduction that you missed out on. So we're going to talk about that. Most of this language is produced by Thomas Brinker, Professor Thomas Brinker. I always start with my story. There's a lot of new faces, so I always tell a little bit about my background. So that's me on the left. That's James on the right. When James was diagnosed at 3 months, he wasn't given a very long life expectancy. He had 14 different disabilities. And so growing up, planning was just non-existent. My mom was just never going to plan. She never really took the time to think about a lot of things because she wasn't given a very long life expectancy with James. But this is James, fast forward to one weekend we never thought we would see. And that's Tim, my youngest brother, on the right. That's James in the middle. And that's actually the weekend, because of their ages, they were both able to graduate high school together in the same weekend. And so it was a very, very emotional weekend for my mom and I. But the moral of the story is, from a planning perspective, don't be my mom. It's never too soon to start planning, to start having conversations. Today's taxes, and there's going to be a lot of concepts that you probably never thought about. A lot of things that you've been paying for years that you didn't know was a medical expense, and it's okay. We're starting today. You're gonna know all the knowledge today, and moving forward, just keep that in mind when it comes to tax season. We bring up the timeline here just to always point out, look, there's a lot of things that are going to happen in your young adult's life. Taxes are an annual thing. And so you don't have to wait for a certain age to qualify for certain expenses or to do certain things. They start today. And so moving forward, why are we having these discussions? Cost of care is skyrocketing. Insurances aren't always covering 100% of expenses. They're not accepting certain expenses. And parents are unaware of mileage expenses, or special school expenses, or home improvement expenses, which we're going to talk about today. Things that have been overlooked in the past. And I'll give real world case study examples when we get to certain slides, and let you know what we've done for clients, real dollars that we put back in their pocket because we were able to do a few strategies. And so we're going to talk today about medical expenses. We'll talk about special schools. For our young adults that are working or potentially have the ability to work in the future, we'll talk about impairment-related work expenses. Very, very important to understand this if you're going to have a young adult that wants to be employed in some form or fashion, but still maintain benefits. And so we'll talk about the importance there. They are an income tax credit, adoption credits. So you can look back 5 years on an admitted tax return. We'll talk about adoption credits for special needs individuals. And then child independent care credit, what it was, what the new tax law increased the number to. So we'll get to all of that. First things first, when we talk about taxes, when we talk about deductions, there's two categories. Either you take the standard deduction, which in 2020 was $24,800 for a married couple, or $12,400 for an individual. You do not take both. You either take the standard deduction or you itemize. So it's very important to understand that. Some years you'll take the standard deduction, some years you'll itemize. Hopefully we can get you to itemize because there's expenses that you haven't calculated before. But just remember, you do either or. They do not stack on top of each other. So these are some of the old numbers, but just remember in 2020, the married filing jointly, I don't know if I can highlight, but is $24,800, $12,400 for individuals. So who may deduct medical expenses? So a taxpayer can deduct medical expenses paid for himself, spouse, and dependents. We really get this question a lot when it comes to divorced families. One parent's the primary caretaker, other parents paying a lot of the expenses out of pocket. Who gets to claim the medical expenses? The medical expense deduction is claimed by the parent who pays for them. So if mom is the primary caretaker, but dad is through the divorce decree required to pay for schooling or therapies or prescriptions, what have you, dad can still deduct the medical expenses, even though the primary caretaker is mom. So it's very important to understand that. Obviously, for married couples, if you're paying it with community funds or separate funds, doesn't matter. You can still claim the medical expenses. So the last bullet point is going to confuse some people, but I'm going to do my best. 10% is historically this threshold. All right, so what do I mean by this? Let's just say a married couple's household income, AGI stands for aggregate or stands for gross income for the year after deductions above the line. So if you make $100,000 a year and that's your AGI, the medical expenses typically have to be above 10%. What do I mean by that? So if you pay for special school and it's $15,000 a year, $5,000 is a deductible medical expense. It's above the 10% threshold. What happened in 2018 and what happened in 2020 because of COVID, they reduced the number to 7.5% of your AGI. So same example, $15,000. Instead of you only being able to deduct $5,000 of that tuition for that special school, you can deduct $7,500 because 15,000 divided by 7,500 or divided by 2. And so it's for 2020, just remember, please, it's 7.5%. I think we got a question just popped up.
So if you're asking if we can share this particular PowerPoint, compliance does not allow us to email this particular PowerPoint, but what we can do is have an offline conversation and make sure that we're giving you tailored advice around that.
Yeah, we've got cheat sheets, like summaries that we can share.
Yep.
Eligible medical expenses. So one of the best rules when coming with medical expenses is if you can get your doctor to recommend any of what we're covering today. If a doctor, a medical professional says, hey, you need this type of prescription, or you need this special diet, or I recommend that this young adult goes to this special school, or you should go to the seminars. We'll talk about all of that. If a medical professional recommends it, it will then satisfy the requirement as being a medical expense. Okay, so very, very important. You can't just come up with expenses off the top of your head and say, oh, whoa, what about all this money I just spent? A medical professional should recommend, or case manager, social worker, if they recommend certain things, document that, and then that will satisfy the IRS for how did you become this expense. So it's just a recommendation. So let's talk about home improvements, because that's one thing that a lot of parents don't know about or don't think about when doing home improvements. So what we did for my real world example, what we did for my brother, we switched carpet floors to wood floors because of the immune system. We had a client install a pool for aqua therapy. Doctor recommended that. We were able to get $26,000 back on taxes because it was a medical expense. And so how do we calculate home improvements for medical expenses? So this example here, say you have to get an AC put in, an updated AC for respiratory, immune system. The cost of the AC system is $15,000 a year, but your home value increased $6,000 because it's an improvement. It's nicer than the standard AC system. So your home value went up $6,000. You're allowed to use $9,000 for medical expenses to add up into that little bucket. Okay, so 15 minus the fair market value increase. Again, guys, this is going to get granular today, but it is what it is. It's $9,000. So like the pool example, the pool cost $40,000. The home value went up 14. That's why we were able to take $26,000 on a tax return. So if you're doing home improvements, we'll talk about some other things too. I want to say this is another very common one. This is extremely common when we talk about forward-thinking residential options. If our young adults are going to live in a home with a few roommates or by themselves, but we need to alter the home in some ways, home improvements or changes will allow us to have more money for medical expenses. Some of that would be entrance ramps for like wheelchair lifts, widening the doorways. My brother is in a wheelchair. So the big thing that the waivers require is a nice big bathtub for him to roll in to bathe. Lowering kitchen cabinets. If our young adults aren't as tall, individuals with Down syndrome, this would be another common theme. Lowering the cabinets to make it easier for them to access things in the kitchen. Adding railings if they have a problem with stabilization. All of this is expenses. Home improvement expenses. Again, if a doctor writes this in a letter, it counts. So these are common things that always get overlooked, especially the wheelchair ramps. That's very common. Here's another list of other overlooked expenses. Prescribed vitamin therapy. That's very, very common these days. Changing up the diets. If a doctor recommends that, that is an expense. Equestrian therapy. We just talked yesterday with a therapy down in, was it Pearland?
Yes, solid.
I can't remember.
Yeah, sorry.
But it's all out of pocket, and that is an expense. Special schools we're about to talk about, medical conferences we're about to talk about, but these are, if you guys want to take a picture of this, we'll have this on the cheat sheet, but these are very, very common overlooked expenses. So when we work with families, we want to give them a list and say, look, if you've got special therapies, prescription vitamins that are not paid by insurance or not reimbursed by insurance, please, please, please keep track of that. That's an expense. So special school. So when we talk about special schools, a few things to keep in mind. Most important thing, a special school, so if you have two kids in a classroom, a special school can be for one child and not the other. One doctor can recommend that a child go to a certain school for that curriculum, but not recommend another child, and that's okay. So a lot of schools would be like Westview, Gateway, any school or tutoring programs that's recommended, tuition, any extra costs associated with the school, application fees, driving to and from school. So 17 cents per mile to and from school every single day. All of that, keep track. That is a medical expense. Really, really, really common that parents don't think of school tuition as an expense, but you can deduct it on your taxes. These are the IRS revenue rulings here. So take note if you do have this. We always try to give as many revenue rulings as possible, just because CPAs typically don't know the ins and outs of medical expenses. It's just not very, very common. And so we like to help you guys with submission and just say, hey, look, this is what I'm signing. This is allowed to be deducted. So let's go ahead and add this to itemized deductions. And this is kind of what I was talking about before. This bullet point here is it can be classified as a, quote, special school for one individual, but not another one. Private tutoring. This is another common one after school. If our young adults maybe aren't in special programs in their school, but they need additional assistance after school, or you help have a private tutor at home, that again, if you pay for that out of pocket, that is an expense. Very, very, very common here, especially when we have some of our higher functioning, maybe getting ready for college and we want to do some SAT prep. We want to do some college course prepping before they go off to college. Again, a lot of these expenses just, oh, $1,000 here. Don't even think about it. Please, please, please keep track of this. We want to keep as much money in the household as possible. Just more information on special schools. Again, we will have a cheat sheet with all, or a dumbed down version of this, not as many bullet points, but at least you can have this. You can submit it with your 2020 taxes if you haven't already. Again, don't forget, Texas has, the United States government has extended tax filings until June 15th of this year for Texas residents. So taxes are not due in 14 days. All right. So we do have some extra time here. Cost associated with the special school, like I mentioned, transportation, 17 cents every single mile to and from school. The meals, if they are not covered with tuition and they're outside of their extra dollars, that counts. If there's any lodging or trips, overnight trips that the school does, that counts. Any textbooks or any other incidental costs, again, all of that adds up. Medical conferences and seminars. So if you're a family that has been recently diagnosed with your child with having some sort of disability or impairment, and a doctor recommends that you go to certain conferences or seminars to learn more about the disability or learn more about options available to your young adult. So like the Texas Transition Conference, if you were to travel to that conference when it was in person, like in 2019, for example, you're able to deduct some of the cost and transportation to and from those conferences. So again, it's just all about adding up the cost throughout the year. And so this was just talking about transportation and costs at the bottom here, $50 per night for each individual, mom and dad is allowed to be deducted. And so this right here is the one thing that I'm most bummed about. In 2019, it was 20 cents. In 2020, it's 17 cents. I don't know why they reduced it 3% or 3 cents, excuse me, but they did. So it's 17 cents for 2020, not 20 cents. Something to keep in mind. And so this talks about the medical reimbursements, the tax benefit rule. So this is just saying if you have expenses at the end of the year, and you pay them and then get reimbursed, or you put them on a credit card and then pay them later, this is the rule for the reimbursement side of things. So I don't know if you guys can see the bottom part or not. I've got the zoom there. So it's the prior year's deduction or the amount by which the prior year's itemized deductions exceed the standard deduction. Again, the standard deduction for 2020 was $24,800. So I don't know if you guys want to take a look at it real quick and I'll move on. I'm not a big reader of the slides, so I'm never going to read you the slides. I'm sorry. But here are some other things. So the flexible savings account and the health savings account, big proponent of HSAs. If you have the ability to save to an HSA through your employer, please max out HSAs. It's extremely important, not just in the short term, but long term for medical expenses. Lowers your AGI, lowers your taxes to contribute to an HSA, and you can carry that HSA on throughout retirement to pay for medical expenses for you and your wife, you and your husband, the young adult that you're caring for with special needs. So please do contribute to the HSA. HSA limits right now. So the FSA is $2,750 for 2020. 2021. HSA as well is $7,000 for a family. So you can defer up to $7,000 into an HSA account right now. Impairment related work expenses. This is extremely important. Again, this is only for young adults that have the ability to be employed or strive to be employed at some future point in their life. So one thing to remember for Social Security benefits. So we're talking right now about RSDI, Retirement Survivors Disability Income or Insurance. That's if a young adult wants to claim a Social Security benefit on behalf of the parent's work history, or they want to claim a benefit on behalf of their own work history, SSDI, Social Security Disability Income. In order to receive those benefits, everyone cannot make more than $1,310 a month. That is considered the substantial gainful activity. That's the income threshold. If you make more than that, you do not qualify for disability benefits. So one thing that we look at is IRWEs, impairment related work expenses. What this says is say my brother gets a job and he makes $1,600 a month. That's above $1,310. Pretty easy math there. But he needs transportation costs. He needs job coaching. He needs on-site job aid. All of those costs get to be deducted against their income to bring us below that $1,310. So if your young adult's making $1,600, $1,700, but it costs them through prescriptions, coaching, transportation, all of that, $1,000 in expenses, you only report the difference between their income and those expenses, not the full income amount. So that helps us stay below those thresholds to maintain government benefits. Biggest note here too is there is no floor, the 2% floor. There used to be old law. I'm not going to confuse you, so I'm not going to go into it, but there is no threshold for IRWEs. So that is good. That's a plus. Their earned income tax credit. We don't use this a lot, to be honest with you. This isn't something that's very, very common with we're young adults here. But essentially there is a tax credit. This would benefit a lot of families that maybe one parent right now is in between jobs, they're not working, or it's been tough for them to get a job, and one parent has a very, very low salary. This is a way to get tax credits based off of income levels. And so you'll see here, the credit is completely phased out at low levels, 46,884. I think it's jumped up to 47,500 now, right around there. So very, very low income levels. But if your family does qualify that, please do not forget about the earned income tax credit. Tax credits, by the way, tax credits are more valuable than tax deductions. So let me say it again. Tax credits are more valuable than tax deductions. Tax credits are dollar for dollar right off the tax due. Tax deductions, like what we're talking about, there's that AGI threshold that you've got to beat. Then it just reduces your taxable income. So tax credits are more valuable. Here's a big credit, probably one of the largest credits you can get. And the 2020 number is 14,800. But if you were in this, again, going back a few years ago, so you don't have to necessarily have just adopted, you can go back and amend tax returns. If you adopted a young adult or a minor with special needs, there is a $14,000 tax credit for adoption expenses. And that's a lot of money to leave on the table. We've come across a few of these over the years that they just say, oh gosh, I wish I knew about that. So please, if you know anyone who has adopted in the past 5 years, or if you know anyone who's planning to adopt a young adult or a minor with special needs, please, please, please make sure you mention this, because you don't have to, and I don't know if there's a point on there. So this last bullet point here, credit claims in the year adoption becomes finalized regardless of actual expenses paid. That's important. So if the adoption only costs $10,000, you're still able to take $14,000. So please, 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 it's a big credit that a lot of people don't realize is there. There is a phase out though. So for the higher earners, there is a phase out. I want to say right now it's at 253. It's gone up slightly. That if you make more than that, or the household makes more than that, there is no adoption credit that available. So there's a phase out. It starts at 212, or excuse me, 212, and it goes all the way to 253 now. So that's something to keep in mind. Again, moving forward is just with more information on the adoption credit. So I'll give you guys a few seconds to read this slide. So child and dependent care credit. So this is really important because it's gone up from $1,000 to $2,000. Again, credits more important. So this is if you have a qualifying dependent. And so if you claim your young adult as a dependent, you do get a dependent care credit. They do not have to be necessarily living with you. So long-term, when we plan, mom and dad are 60s, 70s, 80s, young adult is living, at Daymark or Brookwood or whatever, but you still claim them as a dependent, you still get to take on the dependent care credit or the child credit. So again, very, very important. It's gone up since the new tax law came into place. And so this is some limitations that they have on it. You cannot have, unlimited child care and dependent care. You can't just start claiming a whole bunch of people or family members just because they're old and you're helping them out with expenses. You can't just start claiming everyone overnight. There are limitations that we have to be aware of. And so they talk about that here. I tried to breeze through that because I knew there were going to be some questions, but that's mostly it for today. I want to go back and talk about the IRWEs if we want to, and some of the home improvements or special schools. So I want to open this up for discussion at this point. Is there any questions or any concepts you guys want me to immediately hit right off the bat, whether it's IRWEs, the special school, or maybe some of the overlooked expenses?
Hey, Brian, I'm not seeing any questions in the chat yet, but I know this is kind of it's a very dense topic, right? I know some people are probably trying to just process and wrap your brain around this information. I'll throw a question out there that I was kind of curious. It's not really necessarily related to the topics you were just mentioning, but I was curious about, like you're mentioning, the health savings accounts and expenses. If if you're contributing to the health savings account as much as you can, but let's say you have a really big expense in 1 year, in let's say this year, 2021, but you only have, let's say, maybe the expense is like a huge surgery or something, I mean, $20,000, $30,000, I don't know, really large. And, but in your health savings account, maybe there's only $10,000 in it this year, let's say that you have. Are you able with the health savings account to kind of roll over the fact that you had an expense in 2021 that was really large, but you only had so much of a bucket of money this year, but you've saved more money the next year in your health savings account? Are you able to apply the expense this year and take credit or money from it for the following year from your health savings account?
So it's the year in which you've paid it. So if let's just say, for example, let's just round number, say $20,000 expense. If you pay it out of your HSA, that doesn't count as an expense you can deduct because HSA funds are pre-tax money. So you haven't paid taxes on the HSA. That's why I really like it, because you don't pay taxes on it. You pull it out and you use it for a medical expense and you don't pay taxes on it then. So it's almost like tax-free money for your medical expenses. That's why I really like it. But if you pay, let's just say it's $20,000 and you pay $10,000 out of your HSA and then you pay $10,000 out of your savings account, then that $10,000 out of your savings account, you can add to all your other medical expenses.
Okay. Okay.
We have a bunch of questions in the chat.
Yeah, there are some starting to come in.
Brian, can you see the chat or do you want?
David, my daughter is starting to receive SSI in 2020. Is that taxable? No, SSI is not taxable. Is not taxable. File a tax return, she can. So this was a really big discussion, David, with the stimulus checks that were coming out starting last year, of whether or not your young adult, your daughter in this situation, would receive stimulus checks. She would if she had her own tax return. That's how the IRS knew whether or not to send a stimulus check to an individual. She can file a tax return, but there's not going to be any taxes due. And so if your CPA is going to charge you money for a tax return, I'd probably say don't do it. But you can file a tax return, but she's only going to make $9,500, which is a 0% taxable income. So she's not going to pay any taxes, David. What if the withdrawals are made from a special needs trust? Can you deduct expenses on your taxes? So key word here, when we talk about this question, I bet this is a very, very, very good, detailed, forward-thinking question, so I appreciate it. Withdrawals made from a special needs trust, you can look at expenses for taxes on the trust tax return. 90% of the time, you're not going to be able to deduct those taxes. There are some that you can look at. But you said, the key word here that you said was your taxes. So if you pay funds from a special needs trust, that trust has its own tax return, or it should. And if it doesn't, you need to really talk to your attorney. So the trust tax is going to be separate than your personal mom and dad's tax return. Those are two separate entities, two separate EIN numbers and TIN numbers, tax identification numbers. So no, you cannot take money from a special needs trust, a third-party special needs trust, and pay for the expense and then turn around and claim it on your own tax return, special needs trust taxes. So that's a really good question, I bet. Thank you so much for that. John, can you deduct costs for subscriptions to publications specific to your child's disability to learn more about therapies? So this is a good one. I don't know the answer to that, to be honest with you, John. I don't want to mislead you. My initial gut reaction is if a doctor can recommend that and put it in the file, the medical file, and you get a copy of that, then yes, you could, because it would fall under the seminar and workshop. But that's something to ask the CPA whether or not they would feel comfortable, because this rev ruling here that we would cite does not cover publications or subscriptions. So that's just a discussion to have with the CPA. But if you can have a doctor write that and say, yeah, you need to, subscribe to X, Y, and Z, see if they will count that as a medical expense. I'm sure some will, I'm sure some won't. Some are very strict by the book, but that's a very good question. So I'm sorry, I don't have a more definitive answer. I just don't want to mislead you. While we wait for more questions to come in the chat, I'm going to exit this out. This is the cheat sheet for all the people who attended today that we'll send to you, the 2020 tax year cheat sheet. This is the workshop, dumbed down, less bullet points, just more facts and not as much verbiage, I guess you could say. Again, special school, have it all here. Private tutoring that we talked about after school, the deduction for medical expenses, special diet food, transportation, HSA, FSA stuff. So a lot of, and then again here, the payment related work expenses, a lot of that comes on here. So we'll send this out. I want to say it's 5 pages. Hopefully that answers some of the questions, but again, please ask if you have conceptual questions. Some of the biggest ones are the random expenses that maybe we didn't think about these. So I'll go back just in case we want to jog some memory. Ugh. So any other
I'm not seeing any other questions in the chat, but If anybody else thinks of something, of course, Brian and Tinja, you guys are a wealth of information, and I know we have, maybe do you have that slide that has your contact information again? Put that up.
I think it would be good for us to just briefly, just because what we do is so unique. There are other types of financial planners out there, but because what we do really focuses around planning for 2, maybe 3 generations, this is what we built out to showcase exactly how we work. So when you contract us and go the fee-based planning route, you're basically contracting us for life or for the life of your dependent. So it's really making sure that the foundational side is taken care of. And then year on year, we're taking a look at all the other things that come next. So a lot of times when we meet with families, everything's urgent. Trying to figure out what the priorities are and when to tackle them is really, really challenging. And so that's where we come in, is to make sure that we're quarterbacking what is a priority and why, so that we are able to leave a legacy in the most cost-effective and tax-efficient way. So we charge a fee to build out that plan and to maintain that plan. Then we quarterback with additional professionals to make sure that the legal documents are provided for, that we're getting you to the right CPA. If you need help with IEP or ARD meetings, or connecting with Carrie for her services with the ARC. So it's really making sure that we take a holistic approach and confirm that you guys are solid with your plan. And we have to take a look at all these different things to be able to do that. So yeah, that's how we work over time. Brian, do you have the menu of service?
Sorry, I wanted to.
Oh, do you want to piggyback on that?
No, I'll just answer the question after.
Oh, is there another question?
Yeah, I have it pulled up. Don't worry about it.
Okay. All right. So just to explain visually exactly how we work. So this is what goes into a plan. Foundational plan really just focuses on your kiddo. We quantify the need. If worst case scenario, if you were to pass away tomorrow, how do we ensure their quality of life? What does that look like? We identify what that gap is, quantify it. We take a look at what your assets are now and what we need to in order to fill that gap. And then we make recommendations and action those recommendations, whether it's insurances or investments. We want to make sure that your child is provided for with the foundational route. Fee-based, that includes the foundational plan. So the life care plan, it includes the financial estate plan and mom and dad's retirement plan. So taking a look at everything and being able to project out what the tax implications are later on in life. When to take your RMDs, what are the what if scenarios for residential, talking about, where's your kiddo going to live? What are their priorities? Are we going to do job coaching? What are the what if scenarios that you want to incorporate, and how do we quantify making sure that that happens? So it's very complex, and I'm very proud of what we're able to deliver for our clients, because it ends up being a 200-page document that we review quarterly with you to figure out what is the next priority that we need to tackle. So it's never too soon to start planning. And then we have to, if you're later on in life, we have to do a lot of catch up to make sure that everything falls into place. So yeah, if you are curious about what goes into a plan and would like to set up a time to chat with us, so we usually allocate about an hour to do an intro meeting just to get a lay of the land and see what route would work for you best. So I will put my contact information. Well, Carrie, you're going to send me everybody's contact info that registered, and I'll do a follow-up email, right?
Yes, absolutely. So if you all attended today, I understand the full PowerPoint that was shown here won't be able to be shared, but like Brian was saying, they'll kind of share the bullet points and kind of the meat of the information, and that email, I will send all your emails to Tinja so that she can kind of give you that presentation.
Perfect. Thank you.
So real quick, so we got a question from Gag talking about the cost for attending conference for feeding therapy be applied on tax return. So the cost for attending the conference for feeding therapy, if the doctor recommends that, yes, but it's not, you remember you have to have all the expenses all year be more than 7.5% of your AGI for 2020. Remember, there's a threshold that you've got to meet. So be applied on tax return. I don't want to say yes, dollar for dollar be applied on the tax return. No, unless you have other expenses as well, the mileage, all the, feeding therapy. If there's, like my brother is on a tube as well. So all of his stuff though is covered by insurance. So if you're having to come out of pocket for any of the liquids or food to go for the feeding therapy stuff, that will count as a medical expense as long as insurance doesn't pay for it. So any other last second questions? Again, we're going to send the tax checklist as a follow-up, so you guys will have all of that. And then if you take it to your CPA, it should be pretty self-explanatory with the rulings and the codes. But if there's any questions, we love to educate and coach some CPAs. We've done it before, and just give them some information on, hey, these are allowed expenses to be added up. So whatever we can do to help you guys, that's the end of the day. That's our job. Inform, help, be a resource for you guys. Anything we can do. So
Wonderful.
I appreciate you guys spending, an hour out of your day with us. If there's no more questions, I guess I'll get off here shortly. So I appreciate it.
Thank you, Carrie, for setting this up. This was a pleasure.
Oh, absolutely. Brian, Tunja, thank you so much for being here. As always, wealth of information. And like I said, I think we're all still kind of processing it. So hopefully there will be lots of great questions that maybe we'll roll in emails after everybody's had a chance to kind of think about those additional questions. So thank you again.
Thank you. All right.